Hi everyone, today we are shaking things up a bit. We are diving beyond the usual large caps to explore that exciting world of small and mid-cap mutual funds. Now, these powerhouses usually fly under the radar, but they can pack a serious punch when it comes to wealth creation. Now, the word on the streets, and your uncle's best friend, is that small and mid-cap funds can be risky and volatile, but really, stick around. We'll find out why smart investment and patience with these funds can pay off big time over time. We'll break down stuff from the crazy ups and downs you might face to how fund managers work their magic. So buckle up and let's get started. Small caps and mid caps, the underdogs with a serious bite. Now, if you had put 1 lakh rupees in small cap funds a decade ago in 2015, wow, you're old. Chances are that you would have had made more money than investing the same in large caps, sometimes even double. Sometimes. Now, mid-caps comfortably sit between giving decent returns with less drama than all the little guys. But don't fall in love with the numbers alone. The ride is bumpy. Prices don't climb steadily. They sometimes shoot up, sometimes they dive down, sometimes they go to sleep. So holding on through the dips is really what separates the winners from the quitters. It's like the Mumbai local during rush hour. It's chaotic, but you'll effectively get where you need to get. Here's Tejas Sheth, the fund manager at Axis AMC, talking about this.
So, as AMFI defines, the 150 stocks on mid caps are considered as mid caps, but for small caps, it could range as much as 600, 700 stocks. A lot of emerging industries in an emerging economy like India come through small caps, be it chemicals, be it electronic manufacturing. They have started as a small cap company and eventually they move towards mid cap and large cap. So whenever emerging industry is being played in emerging economy like India, I think small cap is the best place to start with. And that's what the larger difference between small caps and mid caps lies. So even today when we see after the mild correction which we have seen in the market, on 3-year, 5-year, 10-year basis, small caps has outperformed mid caps and mid caps have outperformed large caps. So depending on the horizon, obviously the outperformance in small cap will be larger because you're taking larger risk. And so it's from the mid cap versus large cap that in mid caps, obviously you're taking larger risk than large cap and hence the return profile will be better.
Let's now listen to Samir Raj, fund manager at Nippon AMC, what he has to say about this.
Small cap investing is essentially for the long-term investors. So because you want to really experience the benefit of investing in small cap, you have to give it a time. So in large cap, you can do entry, exit. In small cap, you have to think long-term. And if you want to really benefit out of it, so our experience is that if you give 8 to 10 year time to your small cap investing, chances of you getting poor experience reduces significantly. So small cap, is a very large universe. So, if you are lucky, there's a bull market and if you're able to find some really good multi-baggers, it can make huge amount of difference to portfolio. So if your stock selection is right, the amount of alpha which you can generate over a period of time could be significantly different. So it all boils down to the stock selection and turning out to be a little lucky. So you need to catch some real good multi-baggers. Like if you get that, I think experience will be really good.
From a mutual fund investor's perspective, what is the returns that they should expect or at least hope for?
See, basically, normally, we say that, if there is a real rate of GDP, there is something bare minimum return. Small cap space, the companies are smaller, so they are expected to grow at a faster pace. Secondly, many emerging sector, they start here. So, we are in an era, thanks to technology, a lot of things are changing and many new industries are emerging, which could be fast growth industries. So chances are very high that, most of these companies will be coming from small cap space. So I think if you give it a time and if you do good stock selection, I think the entire space can deliver faster earnings growth than the larger cap space, and that eventually gets reflected in the return.
So let's unpack small cap and mid caps and how to understand them. Rolling returns. Are they a better way to measure performance? Now, returns aren't just about how much you make. Sure, they're important. But these also depend a lot on when you get in. Now, point-to-point returns can trick you if you pick unlucky dates. So it's time you discover something called rolling returns. Instead of one snapshot, these track performance from every possible start date. It's like measuring returns from Jan 1st to Jan 1st, Jan 2nd to Jan 2nd, or Feb 26th to Feb 26th, and so on. This gives you the whole picture, the ups and the downs and everything in between. Now, what this really means is that while small and mid caps can offer bigger rewards, timing matters big time. We have Rupesh Patel, fund manager at Nippon AMC, talking about this.
So if we look at point-to-point data, whether it is 3-year, 5-year, 10-year, 15-year, you will see that small and mid caps as a category have delivered superior returns as compared to large cap. But mind you, this is point-to-point data. You should also look at the rolling return data to draw right kind of conclusions. Having said that, I would like to highlight that your returns from investing in a category, actually it is true irrespective of the category, would also depend on at what point, at what valuations you have entered the market and for how long you remain invested. So you cannot just draw generalized conclusions based on recent performances that a particular category will keep on doing well or a particular category will keep doing worse and would remain relatively underperformer. There are cycles in the market. So depending on valuation, depending upon the financial performance, I think the various categories will deliver returns.
When we're talking about small and mid caps, it's also important that we address volatility. Volatility, what does that really mean? Well, volatility is the root cause of indigestion for many investors, and especially when it comes to small and mid caps. But what is it really? Simply put, it's how much and how fast prices go up and down. Now, small caps are like that Intu kid in your colony. They react sharply to everything: elections, news, policies, random presidents across the world. Mid caps are a bit calmer, and large caps, they're the adults in the room. Knowing this can help you get your head around the roller coaster that you're about to ride. Now, markets have their moves, but don't freeze. You should just move with the beat. We have Rupesh Patel, fund manager at Nippon AMC, talking about this.
So very clearly, if we look at the long-term data, it appears that small caps and mid caps have done better as compared to large caps. But there are associated risks also to the higher returns. The first and foremost risk which comes to my mind is that when you look at small and mid cap categories, these are companies which are relatively smaller in size. Hence, they are more vulnerable to changes in the economic environment. The likelihood of they getting disrupted when macro challenges arises, that is very high. So the financial performance also tends to be more volatile as compared to large caps for mid cap and small cap category. So that is one reason, which we have to keep in mind from risk perspective, that these companies can be much more volatile in terms of their business performance, particularly in a challenged macro environment. Second risk arises on account of the fact that these are relatively smaller market cap companies. Holdings can be concentrated. So the price can also be very volatile. So from price perspective also, the volatility can be higher as compared to large caps. So I think these are the risks which one should keep in mind whilst considering small and mid cap category.
Here's Chandraprakash Padiyar, fund manager at Tata AMC, placing this in perspective.
Actually, to step back, I should give you a different point of view that till 2018, standardized definition of small cap, mid cap, large cap was not there. So we used to, what we today categorize as small caps used to be called mid caps actually. The earlier mid caps have become small caps by definition now. So it's not as if that, so what we as investors used to think that mid caps is high quality. Many of those mid caps have become part of small caps, and we continue to monitor the same companies today. So I think this small cap universe itself has undergone a lot of change after 2018 from a definition perspective. And hence I want to make one point which you didn't ask, but it's a relevant point, is that pre-2018, any investor who invested in small cap as a segment used to see very high volatility in his returns. So 1 year 80% return, the other year 90% loss because of the volatility in earnings profile as well and valuations over a period of time, because businesses were very young and very cyclical as well. With the changes in the universe, I think one you would have noticed in the last, though it's early days, last 5 years only, 5-6 years, volatility is materially down in this segment. And the reason is the universe of this segment. The universe has changed quite materially. And I would not expect that kind of volatility that we've seen in the past. So small cap is no more a dangerous place to invest. It's quite a reasonable place to invest.
Talking about small and mid caps, we should talk about crashes and recovery. And of course, market crashes. Two words that suddenly send your WhatsApp and Telegram groups absolutely mad. So what happens to small, mid and large caps when the market hits the fan? Now, small caps are hit the hardest on their way down, but they also bounce back fastest and strongest when things turn around. Mid-caps fall and recover somewhere in the middle, while large caps tend to hold steady and take longer to rally as well. Now, this dance is really why some investors love the thrill of small and mid-caps and others stick to the safety net of large caps. No judgment here. Different strokes for different folks. The CIO at Motilal Oswal AMC, Niket Shah, is joining in. Let's see what he has to say.
So I think generally what we've seen in I'll give you two scenarios. So one, when market crashes, we generally see quality mid-caps don't fall so much as the broader markets, right? And when the market rises, they're the first one to go off the shelf, right? It's typically only towards the the fag end of the rally or the fag end of the bull market is when non-quality really comes into excitement, right? So you would really see a lot of non-quality stocks doing quite well towards the fag end of the bull market, and that's why when they start doing quite well, people think, oh, the top is close to, we are close to topping out as far as the index is concerned, and hence everyone starts to become more cautious. So I would think quality does play quite an important role, in investing.
Here's how Samir Raj from Nippon AMC puts it.
So recovery could depend, but one thing I can assure, when something goes wrong, small caps are first to fall. Right. So when you're investing in small and mid cap, you have to be ready that you can lose 50% of your money at any given point of time. Because anything is going wrong in the world, small cap will be first to fall. Because they, like if somebody is caught in leverage position or some like forced selling happens, small cap fall at a very fast pace on very low volumes. But good thing is that when things become normal, they can bounce back also at a fast pace. So how fast they will bounce back will depend on what phase of market you are and what is the kind of bull run which you're gone or how. So it's a very, like in all bull and bear market, there could be slight difference in how things can go.
After a crash, there is a new leader. Leadership rotates. Who leads after a crash and why does it matter? Now, after a market crash, top names often change. You have small and mid caps that usually lead the charge in the comeback, as we spoke before, because they tend to bounce faster when the optimism returns. Now, these stocks also tend to get cheaper during the crash, and as the market recovers, their earnings and valuations can rise quickly, and that catches the eye of investors who are, keen to really ride that wave. Here's how Chandraprakash Padiyar from Tata AMC is thinking about it.
So I would say that between 2020 and 2024, the last calendar year, from the base of earning that we were there, profit growth in mid caps and small caps for the last 4 years at a stretch was either double or somewhere around that to the large cap segment. So since your profit growth consistently for 3-4 years was so high, mid caps and small caps did a better job on returns related to large. So it's a function of earnings and at the starting valuation at which you were at that time. I think in 2019-20, valuations for mid cap and small caps were either equal to or in many cases lower than large caps. So when your profits grew so fast and hence your valuation re-rating happened. Incrementally, I think from a benchmark index perspective, but Bloomberg consensus tells me that Nifty earnings are expected to compound at between 12 to 14% CAGR for the next few years, whereas mid cap index and small cap index, even in the next few years, as per Bloomberg consensus, is estimated to compound at a 50 to 60% higher rate than large cap index, which means that consensus estimates are continuing to believe that the next few years will still be a good period for mid and small cap in terms of earning growth. So if that happens, then I would say that probably for some more time, returns can still be better. But to an extent, valuations are higher. So I think many of these good things are in the price, at least for the immediate 2 years, which is why I was saying that incrementally, at least our view is that you need to be very selective. You cannot take a mid cap bet or a small cap bet as a general bet, which is why you asked me a question of index funds in small caps, and my answer was no. I do not believe that investing in a small cap index, an investor may be able to do a better job in the next few years. In fact, you need to be very selective and choosy in what you buy today from in a small cap segment. So at least we are hopeful that we've done a better job in identifying some select companies, and we will still do a good job. But from a general consensus basis, I think I would say that risk reward looks better in large caps relative to mid and small cap from an index perspective. Stock selection will always do better.
Have you ever wondered which segments have faced the longest dry spells? Now, small caps went through a 12.5-year stretch where the returns barely budged. Now, mid caps and large caps have also had stagnation spells, just that they were shorter and gentler ones. And yeah, you can call this cherry picking. If you had picked up small caps just a year earlier or later, the numbers would have looked far better. Now, the point isn't here to scare you, but to show that such long dry phases do happen. And this tells us that investing isn't only about enjoying the highs. Sometimes it's also about patiently enduring the dry seasons too. It's like waiting for the monsoon rains in May. Frustrating, but kind of necessary. Let's hear what Chandraprakash Padiyar, the fund manager at Tata AMC, has to say about this.
So that will happen if this rally were to continue for, let's say, I'm just guessing, for the next 2-3 years in the same manner as it was in the last 4 years. Given the earnings profile that we see, then valuations will go beyond a particular rational level, which will mean that incrementally returns can be very, very low, either low or negative as well. So it's all a function of what earning growth you see and what valuation you are paying for a business. For example, in 2024, let's take a recent example. 2024, many businesses in small cap, even in mid cap, even in some large caps, started trading at 100 PE, 2-year forward, 3-year forward. Even today, I see 70, 80 PE as a norm, which means that those set of businesses which are trading at that high valuations, I will bet that the next 5 years returns will be either zero or negative as well, even though the business will do well. So it's a function of earning growth and valuations where you are. So we at least keep a very close eye on valuations and earnings.
Let's listen to Niket Shah from Motilal AMC.
I think, the best way to do that, I would think is, look at the PE multiples of that space, right? So for example, midcap PE multiple had gone north of 35 times, right? And which is a clear signal that this is not sustainable, right? As compared to Nifty, which was closer to 19 to 20 times, right? But obviously there was lower growth on the Nifty side versus mid and small, where the growth was higher, but the multiples are also meaningful higher. When we see those kind of multiples coming in, I think it's quite clear that you will actually see some consolidation happening in mid cap and the small cap space till the time the multiples come back to the normalized level, and then you again start seeing that rally happening. So I think investors do need to focus on the multiples as well and the valuations as well.
Yes, Shreyansh Devankar, fund manager at Axis AMC.
That is the exactly time period which you are highlighting, wherein you started at the market peak and 2020 was a period where the market was bottom. So if your starting point is peak of the cycle, normally what happens in mid and small cap is, generally mid cap and small cap, I don't want to classify them as a low ROE, but certain segments of mid and small cap like chemical, like auto ancillaries, and many places in the capital goods as well, they are inherently low ROE and low free cash flow businesses. When the cycle is poor, when the numbers are bad, for the low ROE, low free cash flow, the multiple get depressed up to 10 to 20 to 13 PE. Actually, in certain cases, it goes even as low as 7, 8 PE or 5 PE also. So, while at the peak of the cycle, when the growth is 20%, market is ready to give to such business, because at that growth, obviously the ROEs goes up to 18-20%. And free cash flow also improves. At that time, market is ready to give them multiple of 25, 30, 35 as well. Now, if you look at the range of this multiple, in the bottom cycle, 8 to 12 to 15. In the top cycle, you are at 25 to 35. When this multiple gets shrunk, that actually erodes your value. On the contrary, in the bull cycle also, this multiple expansion creates the most of the wealth, rather than just the earning compounding. And that's where this multiple expansion and multiple compression is one need to keep in mind. And that creates the difference between your 10-year returns.
So what should your investment style be, active or passive? What works better for small and mid caps? Now, index funds and ETFs are totally all the rage. And a common question is, why should I pay higher fees for active mutual funds? You see, in large caps, passive often holds its own or even wins. But in small and mid caps, active managers have all the edge. Why? You see, small and mid caps are less covered. Their info is more scattered, and picking winners takes real skill. Now, good fund managers, they dig deep and they spot gems others miss. So in these categories, active management can make a total difference. Sometimes you really need that Sherpa to guide you through those investment mountains. Let's listen to Niket Shah from Motilal AMC.
Well, I think index investment does make a lot of sense in the mid-cap space sometimes because it's quite difficult to beat the benchmark index. If you look at the data as well, we've seen only few funds beating benchmark. One of them is us, but even if you look at the industry per se, in a market which is, in the last 4 years when markets were going bonkers, you would have seen that only few funds were able to beat the index. In those cases, yes, index does, investing in index fund does make sense in the mid cap space. But in the small cap side, it's quite easier to manage because, in a bad market, the non-quality stocks will fall far more higher, and hence mutual funds in the small cap space will tend to do far more better. So I would think that in the mid-cap space, there is some opportunity for the index fund as well. Yeah. So I would think that managing large-cap fund, again, large-cap companies, whether it's banks or whether it's IT, I think the names are right up there, right? So it's not a difficult thing to really figure out which one is going to do quite well. In the mid and small-cap space, to get ideation right is quite difficult. You have to work 3 times more harder as compared to large-cap. Because there are multiple cuts to look at it, right? In large cap, there's clear view that the governance is not a concern, right? In mid and small, you have to check for governance at all points of time. And hence, I think there is a little more detailed work required on the mid and small cap side as well.
Now, where funds put their money reveals a fair bit. Large caps tend to stick to favorites, banking, finance, IT. Mid caps tend to diversify a bit more. They're really looking at boosting India's infrastructure, manufacturing, or healthcare. Small caps, these are the most adventurous. They're hopping through sectors like plastics, diagnostics, logistics. Now, this portfolio allocation really explains the volatility and the growth potential in small caps. Think of it like a thali. There is some sweet, there is some spicy, but there's a whole variety on that plate. And to understand this better, here's Shreyansh Devalkar, fund manager at Axis AMC.
At different points in time, different sectors do well. Just to give you example with sectors here, 10 years ago, there was nothing like electronic manufacturing services, right? And today, that is a big sector for small cap. In mid cap also, there are companies. In large cap also, there is a company now. It has become large cap. This sector was not present. It was totally absent. You take quick commerce, but this is not in the mid or small cap. You take actually chemical industry. So chemical industry 15 years ago, actually now, 15 years ago, it was virtually non-existing as far as market cap. If you notice, many companies are existing and many promoters are existing since 80s, right? But earlier sector was not conducive. From 14, 15, that sector started doing bad. And from 14, 15, 16, 17, 18, 20, actually market believes that only after 22 they did well, but actually those companies started doing well during that time. So at various these sectors of mid and small, there are multiple other. You take a capital market again in a small cap. That sector, when the market was dull, nothing was happening. And for 10 years, no one looked at it. And today, that is one of the hot sector too, right? So these things change based on the cycle in those particular industry. And that leads to one angle and that's why as an investor, when we are investing in a particular stock, we try to see to it that how much percent of fund is in long-term structure, what percentage of fund is in mid-term structure, so and what percentage is very short cyclical. So the last part we tend to avoid.
You talk about markets and everyone wants to know which small or mid-cap fund is the best right now. The answer? That changes fast. Now the fund on the top today might be nowhere tomorrow. And over the last decade, many funds have hopped in and out of that winner's circle. Why? Market changes, your manager shifts, and as funds grow, their strategies are also adapting and sometimes even losing that edge. So chasing top performers is tough business. It's better to focus long-term and pick managers with consistent skill and discipline. Because like cricket captains, every star has their innings, and after that, it's time to choose the next star. A big thank you to all the fund managers who joined us today on this special. So that's our 10-point guide for small and mid-cap mutual funds. Now these pack a punch with exciting growth, but they come with bumps along the way. Patience, timing, and picking the right fund manager really makes all the difference. Remember, this is a marathon, not a sprint. And it's also important that you understand your risk appetite, you stay steady, and you keep learning. And to keep learning, check out Groww for more videos and insights to help you navigate these markets. And happy investing. Don't forget, there is no shortcut for good research and patience. Because in investing, slow and steady often wins the paisa.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.